77.80 on the PAT, and as opposed to what the ET Now poll was penciling in, about 76.80, it's a bit of a beat actually coming in from TCS. But I won't, rush in to really hand out a verdict when it comes to TCS's numbers. It's really not about the quarter gone by. It's absolutely irrelevant. What we really need to see is the kind of management commentary, the large deal wins, what they have to say about the digital pipeline, whether any client-specific issues or not. The body language, I think, is going to indicate more about TCS than anything else. But you got to do what you got to do. So we're here to analyze numbers. I'm just waiting for what the dollar revenue, etc., are and what they have to really say about the commentary. I think that's going to be extremely key when it comes to TCS. While it's a given that this is going to be a painful quarter, you have to map how the stock prices have already absorbed that. So I was just looking at the stock data from mid-April, say about April 16th or so, when the stock was pretty much at the 3-month lows of about 1772. From there, there's been a steady recovery in not just TCS, but the entire large cap IT space as well. The stock is already at 2198, even though it was a flattish move in today's trading session. But then again, it has been a stark recovery from those April lows, and I'm not even talking about the March lows here. So from there, I think the street has pretty much absorbed that it's going to be a weak quarter. It's not really about Q1. It's about, like I said, going forward. Remember, in the previous quarter itself, the management had indicated that, okay, I stand corrected here. Now you got the TCS numbers. I don't know what we flashed earlier. 7,008 crore rupees on the PAT. So that's starkly lower than what the ET Now poll was penciling in. 76.80 was what the ET Now poll was penciling in. Just very quickly on our, basic number analysis of the dollar revenue, we're expecting about $5,130 million odd dollars. The revenues are going to be lower by about 3%, and this is what the ET Now poll is penciling in, and the EBIT margin at 24.4%. In fact, you know what? While we're still awaiting the numbers, let me quickly take it across to Poonam Sani, my colleague who tracks the numbers rather closely. Poonam, I just have the first flash. That's the PAT figure, and that looks like lower than our estimates.
Well, in fact, if you look at, Aisha, if you look at the constant currency revenue, there's a degrowth of nearly around 6.3%. We were expecting a constant currency revenue degrowth of close to around 5.6%. So clearly a miss on that front. We were expecting a PAT of 7680 odd crore, and of course the PAT is far lower at 7,008 crore. In fact, if we are looking at the overall revenue figure as well, it's a miss on that front. Operating margin has come down significantly. It is at 23.6% versus our expectation of 24.4%. So it's a miss in terms of the operating margin, miss in terms of the revenue as well, in terms of constant currency. Even in terms of the rupee revenue, it's a miss. Q1 deal wins stand at $6.9 billion. This it was expected that the deal wins this quarter is going to come down, because if you look at the deal wins, we did see a good amount of over $8 billion worth of deal wins in the last quarter. So there were expectations that it would be slightly coming down during this quarter. So as such, Aisha, first cut, yes, it's a miss on revenue margin front, profitability front. Rajesh Gopinathan, of course, does mention, that management does mention, the revenue impact of the pandemic played out broadly along the lines we had anticipated at the start of the quarter. He also says that the revenue impact is overall playing out long.
Yeah, Poonam, I'm going to take it from there. The CEO commentary, I think that particular phrase says it all. He's saying that we believe COVID impact has bottomed out, and he's sticking his neck out. Remember, last quarter itself, they said that they're going to see improvement come Q3. So him going on record and saying in an official statement that we believe COVID impact has bottomed out and we should now start tracing our path to growth, I think is a very categorical statement. Urmil Shah, hi, evening. I know we got to do what we got to do, but I'll analyze the Q1 numbers later. What are you making of the CEO commentary? And I'm going to just read out some more comments coming in from Rajesh Gopinathan. He's saying the revenue impact of the pandemic played out broadly along expected lines. My reading of these statements is going to be that body language is extremely confident.
Yeah, I would agree with you that, they are sounding quite confident. And in fact, amongst the large caps, even at the end of Q4, TCS was one of the few companies who had talked about that they are expecting growth to improve from Q3 onwards. While the revenue number for this quarter is a slight miss, but I think more important would be to look at the outlook for rest of the year, which appears to be positive than what it was expected earlier. Of course, we'll get to understand more as regards what is going beyond the comment that it has bottomed out, the impact has bottomed out in this quarter, at the pressure and the earnings call.
Right. I think we also have Madhu Babu joining us from Centrum. He's joining us live. Madhu, I hope you had a chance to look at the numbers. On the face of it, it's below our estimates on all fronts, be it revenues, operating margins, or profit. But what do you make of the commentary?
Oh, I could not go through the numbers, but I was looking at a 6% kind of decline in constant currency and a 60 basis points kind of margin drop. So that was my estimate, but I think people were anyways looking at this result with a pinch of salt, and everybody's focus is on the outlook, whether the 2Q, the stabilization will happen, and whether the recovery will happen from the second half. So that is the key, and the commentary and the body language of the management, that would be key for the stock.
Yeah, I'm going to take over from there. Madhu, I'm just going to quickly read out the numbers for you as well, but that's largely below expectations. What I'm going to talk about is what the segmental industry verticals are like, because the takeaway is that all other industry verticals have shown declines of varying degrees. BFSI has degrown by about 4.9%. What's going to be critical, Madhu, going forward is whether or not, IT and not just TCS, but IT sectors, the big boys, Infosys, TCS, TechM, whether they can really make use of this COVID opportunity and get a piece of the pie of this entire digitization which is playing around, and whether or not TCS can actually bank in on digital revenues, and can they come in higher or not. What is the estimate that you're penciling in while I'm still waiting what the digital revenue exact breakup is like?
So you have to see it in the context. I mean, one set of industry is completely troubled. So let us take retail. There are around 25,000 stores in US alone who are going to be closed this year. So one set of retail companies might be doing well, but others are hit substantially. So this digitization would be continuous stream of smaller projects. So I don't think that will move the needle to get a growth. So obviously they have been doing that, and now with this COVID, obviously we'll be trying to work on the supply chain and the interface layer and all. But that will not move the lever for the overall growth, because still a large chunk of the business is traditional business, and there the pricing pressure is significantly higher, especially in this kind of scenario. So, I mean, obviously these will be opportunities across verticals, but these would be smaller projects. So that will not move for a TCS, which is almost like 22 billion kind of annual revenue. That is my view.
Sure. Okay. Life sciences, healthcare has continued with their growth strong at 13.8% on a year-on-year basis. BFSI revenues have degrown, -5%. Retail, CPG revenues have degrown at 12.9% on a year-on-year basis. And like I said, all other industry verticals have shown declines of varying degrees. BFSI has degrown by about 4.9% on a year-on-year basis. IT services attrition rate, that stands at 11.1% LTM, and I'm just going to quickly dig out that detail that we had on the deal wins as well, and I think $6 billion, was that the figure really? I will just come to that in a second. The EBIT, that stands at 9,048 crore rupees. The CEO is saying that we believe the COVID impact has bottomed out and we should now start tracing our path to growth. Rajesh Gopinathan sounding extremely confident, also saying that the revenue impact of the pandemic played out broadly along the expected lines. And there is one more comment where I'm just going to dig out for you as well. He's saying the revenue impact of the pandemic was along expected lines, surely. The PAT at 7,008 crore rupees, operating margin at 23.6%, and the net income at 7,008 crore rupees, which is down by about roughly 14% on a year-on-year basis. Madhu, but the only thing, and I completely agree with your viewpoint here, but the only thing is that the fact that Q1 was going to be a weak quarter, that is something that the market has already priced in. I was just digging out data from mid-April, April 16 to be precise. The stock was at 1772. From there, it's climbed all the way to 2198. This is something that the market is already priced in. Going forward, especially given the comments that are coming from Rajesh Gopinathan, and if I recall correctly, even the previous quarter, they said that they actually have visibility that come Q3 and things will begin to recover. And now Rajesh Gopinathan actually coming out on record and saying precisely the same thing, that he has clear visibility on when things are going to recover. Do you think that will be taken positively by the street? And should we hope this recovery on TCS to only continue come tomorrow?
Yeah, so I think what will happen is, one is that whatever the pent-up investments which are being put on hold, so once the clients get a confidence, so that budget would be eased. And second part is that whole COVID-led supply chain disruption and, work from home, some of the captives have suffered. So some of these larger players can benefit from these larger deals and consolidation in their favor, because larger players have been able to execute better and maybe even give more flexible payment terms in this crisis. So that could be driving his confidence to an extent that, once things are stabilizing at the macro level, you'll have a pent-up demand. And most importantly, you have to remember, a lot of developed countries have given a huge stimulus. So in US, if you see, people have been, money has been deposited in the accounts of a lot of people in that sense. And even small businesses have been deposited with huge chunks of cash. So banks are flush with cash in US in that sense. So stimulus has also, to an extent, arrested any steeper macro impact from the COVID crisis. That's my view. And one more last point I would like to add is the valuation. So stock is already above pre-COVID levels. I think if you take the earnings downgrade, the PE multiples of TCS have actually re-rated. Pre-COVID, it was the high was around 22 times FY22. Now it's almost more than that, 23 and a half times. So actually, despite a dollar revenue decline, which is being expected for this year, the stock has re-rated in terms of PE multiples. So I think there's hardly room for much upside. I think the stock is already factoring the recovery and the positives. So it's very difficult for any analyst to justify beyond 2300, 2250 for the stock, because multiples have already re-rated substantially.
Okay, the Q1 deal wins, that stands at $6.9 billion versus about 8.9, and that is the figure really coming in. I'm just going to try and dig out some more details for the benefit of our viewers and really see where exactly are we headed when it comes to TCS from here. But while I get in some more details on where exactly this is headed, Urmil, just wanted to understand, do you sense that with the deal wins coming in at $6.9 billion, there could be certain issues with large deal wins? I'm waiting to hear the management commentary on that, and while I wait that, just wanted you to second guess whether or not there could be any issues with regards to it.
So we need to keep in mind that, the first half of this quarter has been a really difficult quarter with a lot of uncertainty at the client's end. So it wouldn't be reasonable to expect the deal flow to be good in that period. So it is likely that TCS might have done the heavy lifting as regards the deal wins of 6.9 billion in the second half of the quarter. And nevertheless, Q4 was a very strong quarter as regards the deal wins. I believe more important would be the commentary on how the ramp up of these deals is expected to see, because I would say that whatever is the miss that is happening in Q1, if the commentary about Q2 getting back to growth itself if that is the case that Wipro is looking at, then I would say broadly, the cut on the earnings might not be very significant because we were expecting second quarter also to be slightly soft and meaningful growth coming from Q3 onwards.
Do you think near-term issues like US president elections or rather US presidential election rhetoric, etc., could dampen the spirit in the near term?
I think the news flow on that front has been coming. The risk was on the restriction on the visas. The news flow has already come in, and despite that, there has been a re-rating in the stock along with the sector. So we do not expect a incremental negative news flow on the visa front. So I do not see a case for an incremental negative news flow.
See whether there's any commentary on the BFSI space as well or not. Given that, Madhu, the performance as such hasn't been all that impressive, what do you think is going to be the management commentary, and where exactly do you think they'll be able to, sort of catch up in the BFSI decline that one has seen in Q1?
First, I think the decline is on a YOY perspective. We have to see the quarter-on-quarter dollar term number. Commentary of TCS usually tends to be more balanced and optimistic. I mean, relative to any other peers, I think they have always been the most optimistic. So I think they will guide for stability. And you have seen that in Accenture's commentary as well. Accenture, which is the largest player, I think, which is again neck to neck with TCS in terms of headcount. Even Accenture has guided for more stability. So there could be some consolidation in flavor of the larger players. I mean, especially some of the captive work also might go to the larger players because captives have struggled in this execution in post-COVID. So that is one important point. And despite whatever being the commentary, I think the incremental upside in the stock cannot be more than 3-4%. So even if the stock goes up, it can't be more than 20 to 50 kind, because valuations are already pricing the second half recovery and FY22 growth.
Madhu, I like how you're doing my job. That should have been my question. Where is the stock going to go from here? But thanks as always for that. Stay on with us. I'm going to quickly take it back to Poonam Sani, my research analyst. She's digging out some more numbers. Poonam?
Well, I guess Ashley had covered most part of the entire results, I guess. Most importantly, Aisha, again, it was the commentary that was keenly awaited, and with the CEO stating that we can possibly, most part of the COVID impact is now over and it has bottomed out, and we will probably be starting to trace the path of growth. I guess, Aisha, that is the most important part to be taken ahead from, I guess. Besides that, of course, if we are looking at the overall results on the top line front, on second thoughts, it's an inline number. If we look at the EBIT margin, yes, it is a sharp hit on the EBIT margin at 23.6%. Profit, of course, has come down again. It is below our expectations. If we are looking in terms of the verticals as well, the BFSI segment as well as the retail and CPG segment contribute most amount of the revenue to TCS. BFSI segment has degrown by 4.9%. Retail and CPG vertical has degrown by 12.9%. So yes, in terms of that, we will have to watch out for management commentary, especially on these two segments, as they're contributing strongly to the overall revenue. Besides that, again, it was expected that Q1 would be a washout quarter because of the entire COVID impact. And also do note that, Aisha, if we are looking at from a stock price perspective, I think it's a defensive play.
Again to all of you, and thank you for joining our Q1 press release. As Arushi said, I hope we find all of you and your loved ones safe and healthy. And thanks once again for taking the time to join us for this. Q4 earnings release was a time when we spoke about the operational agility and adaptability of the TCS operations and execution engine to quickly come together and envision a future of what we call the secure borderless workspaces and to boldly define the 25 by 25 vision. Q1 saw institutionalization of this activity and an execution of that at scale, which would have been quite unimaginable even a few months back. We have had systematic expansion of SBWS from beyond just service delivery to all aspects of our organization. This has included executing more than 32 transitions in a completely digital, contactless manner. And in the process, we are very happy to have onboarded hundreds of new associates from many of our customer organizations across UK, Europe, and North America. So this quarter, the first quarter of financial year 21, has been a very satisfying quarter from an execution perspective. But the story of Q1 is not about SBWS and execution. The story about Q1 is about the amazing TCS family that has come together and stood shoulder to shoulder as one TCS and has defined our organizational response both internally and externally to this crisis. It's a story that is unimaginable in its scope and the impact that it has had, not just on us as an organization, but on our extended ecosystem of both our customers and the various other stakeholders that we touch every day. To take us through in a very brief way and to do justice to what has happened, I want to call upon Milind to share a few words before I go back to talking about the actual performance of this quarter. Milind, over to you.
Thank you, Rajesh. Thanks everybody for taking the time to be here. As mentioned earlier in our last quarterly briefing, in these challenging times, for us, associate health and well-being is paramount and has been a key factor for all our decision making. Over the last 3 months, we have not only connected with 400,000 associates on one-on-one basis, but we also connected with all of the 40,000 fresher recruits coming one-on-one and who will be joining us from mid-July through the year. To address, associate mental and physical health, it is, like I said, associate health and their well-being is paramount for us. And that has been a key priority, the key factor for all our decision making. So we have taken various steps, establishing a global medical hotline. We have a very large counseling services network even before COVID. We expanded that network quite a bit. Provided quarantine facilities across all major cities. To our associates, enabled repatriation. People coming back from various countries back to India, establishing one TCS channel. Where we got motivational speakers to come and speak about various things to keep our motivation of our people high. The CEO and senior management town halls, so important in these situations where we have to continue to basically, the senior management comes and talks about the big picture all the time to our associates. Enabling social connects for fun, for various social activities so that people can connect outside of the work and providing a channel for that. And I think, and such as talent hunt competitions, which is going on right now, So it is extremely important that, we take care of this aspect of health and well-being, as a core aspect, core strategy for TCS in these challenging times, Everything we do has to be centered around this aspect of it, and everybody needs to understand. We have, seen a number of people, obviously, a lot of us have, going through various situations, anxiety, frustration, loneliness, family issues. Maybe you can name it, and there are challenges which are going on. And how does a company like TCS, who have been, known for our values and culture, come and participate in much bigger way to take care of our associates' health and well-being? I think very important things which we need to do, we continue to do, and and we'll continue to enhance, change, and accelerate some of the things which we are doing here. Very critical. Second point I want to briefly mention is about talent development. Lifelong learning is a core value of TCS. How do we bring in basically that learning into our new operating model was our key priority this year. During this period, we further strengthen our state-of-the-art learning infrastructure, to do various things for our people. And as a result, our learning intensity has gone up almost by 24% in this quarter. We kind of stopped all junior recruitment in the last quarter. And all our fulfillment was done through strategic talent development. About 4,500 positions got fulfilled as a result. It was extremely important for us to connect with fresher recruits during this period, because they need to be reassured that yes, TCS is hiring and TCS will have given you an offer. You will come to the organization. They got delayed because of their academic term getting delayed, but they actually are coming in, and all of them will be joining us from now through the year. Innovative learning interventions, virtual hackathons, where 1,500 people participate every week. These kind of interventions and driving that intensity of learning during this period actually took also some mind away from things where it should not be, and it played a big role in also bringing people's morale up in terms of keeping them busy in the constructive things and not have them think about negative stuff. The third point I want to bring about, and it's much talked about topic lately, is about U.S. President proclamation. This proclamation is unfortunate and unfair from our perspective. From a business perspective, in a short term, we will have some impact, but considering our strong supply and delivery ecosystem in the US, and with our customers adopting SBWS, location independent model of SBWS, I think we will actually be able to manage this situation in a short term. On a longer term, based on how the situation evolves, we anticipate challenges. From a sourcing perspective, as the fair share of students in the STEM discipline are international students. The treatment of international students and potential changes in the OPT regulation in the future will have implications not only on us, but on the future of technology development in the US. I think more importantly, from an associate perspective, this is extremely unfair. It is important for all the stakeholders to understand that the proclamation is causing enormous amount of uncertainty and anxiety to our associates. Remember, these associates help run the major banks, the retailers, the manufacturing companies, the telcos, every day, thereby significantly contributing to US economy. We understand and empathize with our people. This is the situation we are in, we are all in it together. We understand and empathize with our people, and they know that will take care of them during this uncertain situation and beyond. Extremely important for all of us to understand that we are all in it together. There will be situations, there will be regulations, there will be different times. We'll have to deal with it. This is another thing which we will deal with it and move forward. The fourth point I want to quickly bring up, and it gets asked to me quite often, is what are your plans to returning to office? Currently, globally, 1% of our workforce is working from office or customer locations. Including creation of across the facility, risk profiling, self-declaration, many mandatory trainings, and provided very safe transportation and quarantine arrangements. Incident response, standard operating procedures, when we detect a case inside the office, all of that has been done. We have also implemented our own state-of-the-art product for risk prediction of our people, for selecting people to come to work. All of these things are in place today. Having said all of that, we are still, actually, we want to be very conservative in bringing people to work. And our strategy varies, based on the COVID situation in each country, in each city, all of that. We expect, across the globe, we expect about 5% of our workforce coming to office by the end of this quarter. I think, this is how the situation will evolve. Our 25 by 25 model will also basically get established as part of this process. And we will actually, this is our alignment with the new normal. With that, over to you, Rajesh.
Thank you, Milind. And as I said, this is a quarter where the TCS family has truly gone over and beyond anything that could have been ever asked of them. And I want to thank each and every TCSer for having done what they've done and for continuing to do what they're doing to make the results that we're going to talk about possible. With that, let me turn to the results and the specifics of it. Could I have the highlight slide, please? Thank you. So we ended Q1 at 38,300 crores, which is a net reduction of 6.3% on a year-on-year basis, broadly in line with the expectations that we had going into the quarter and which we had shared with you at the end of last quarter. The impact of currency further accentuated this from a dollar perspective, but from a rupee perspective, we are actually happy that we have ended the quarter on a year-on-year basis, marginally positive, with a growth of 0.4% in reported INR terms. From an operating margin perspective, we have been able to deliver 9,048 crores of operating profit, which is an operating margin of 23.6%. And this has been a phenomenal effort by our entire operations, finance, and business folk, because this margin defense has come while we have stayed very, very supportive with our extended employee ecosystem, as well as with our customers who have been going through significant stress. By tight financial management of ancillary expenses and by a very focused approach to it, we have been able to minimize the significant impact that you're seeing on the revenue line and defend the margin and keep it within a manageable range. From a net margin perspective, we have ended the quarter at 7,000 crores, slightly more than 7,000 crores, which is a net margin of 18.3%. From a cash from operations perspective, once again, disciplined execution and the focus that the organization has been able to build is coming through and shining through in this number. We have ended with one of our highest cash conversion ratios, with the cash from operations at close to 9,300 crores. Once again, this has come despite a very supportive stance towards customers and also to all our partners and key providers who are an integral part of the overall TCS business model. Our payables, especially of our smallest vendors, has been 100%, and we have continued to maintain that and yet been able to deliver a significant outperformance on the cash side. We are ending the quarter with slightly more than 51,000 crores, and which keeps our overall capital return plan on track, despite the significant impact that we're seeing due to this pandemic. From a customer perspective, we are ending the quarter with 4 more customers at 48 in terms of the highest 100 million plus revenue band. But the story on the customer side is beyond the numbers. This has been a quarter where our actual connect with our customers has increased significantly. Our across multiple executive levels, our overall engagement has gone up by our estimates by almost 3 times. And we have been able to actually seamlessly switch over into this new operating environment and use that to an overall advantage of increasing both the volume and the quality of the customer dialogue that is happening, and which has been critical to ensure that we are aligning to the requirements of our customer and making sure that we are fully focused on the direction of recovery that we foresee and we are anticipating. From a segmental perspective, this quarter has been along the lines of what we expected. Verticals, especially life sciences, healthcare, pharmaceuticals, etc., they have continued to maintain the growth trajectory and are growing still at close to mid-teens numbers, going at about 13.8%. Most other verticals have been impacted in some way or the other by the overall economic impact of the pandemic. Our largest vertical, banking and financial services and insurance, has had a 4.9% year-on-year decline in revenue. Within that, insurance continues to do better, while capital markets and then followed by banking, which has seen a short-term impact, whereas we believe that it will recover during the course of the second half of this year. Retail, travel and hospitality, and CPG has been the industry that has seen the maximum impact due to the pandemic. The demand destruction in this vertical is significant, given the sheer economic impact that it has had across many retailers. Even within that, there is a full spectrum of both impact as well as recovery paths. And I'm glad to say that we have stood shoulder to shoulder with our customers and have been part of their recovery planning and recovery journeys. And we believe that we will continue to participate in that journey, both in its impact as well as in the recovery as it unfolds. From a geographical segment perspective, Europe, which had been on a significant growth trajectory, continues to maintain a growth momentum, albeit it has been impacted once again by the early impact of COVID. However, from a geography perspective, we see Europe as being most ahead on the recovery curve, and most of our customers in June are seeing good traction and good positive momentum, and we expect Europe to go back to its higher growth trajectory during the remaining course of the year. The United States has been among the most impacted, but also has been among the most resilient and adaptable in recovery and in planning for it. Overall, the sheer magnitude of the impact has been high, with year-on-year revenues reducing by 6.1% to 2.6 billion for the quarter. But as I said, it is one of the most innovative ecosystems, and there have been multiple instances of clients coming up with significant new innovations to deal with the pandemic, whether it be retailers coming up with curbside pickups and other such operational improvements, or our participation with areas like pharmaceuticals and medicines and delivery, which had to be, their supply chain networks had to be reconfigured almost dynamically to reprioritize where the medicines are required and the endpoints where the medicines need to be delivered, which were keeping on changing on an almost real-time basis. Similarly, supply chain changes to deal with the fact that a lot of air traffic had gone off the network, and making sure that critical medical equipment and deliveries are made available, to make sure that the significant support that governments were extending to companies of all sizes were efficiently channelized to the banking and financial services channels, and to reconfigure their systems to be able to deal with that unexpected spurt. All of these are areas where we have seen significant activity and been participating very strongly. And we are quite positive and enthused by the extent of the innovative force that has been unleashed to deal with the pandemic across these markets. Then coming to UK. UK has been probably the most unfortunate in terms of having the twin impact of Brexit and COVID come together in this period. And that is showing through in our overall numbers. Our business in UK is down 8.5% on a year-on-year basis to 770 billion on a quarter. But I'm glad to report that in the market, we have outperformed everyone and have emerged as the second largest technology services provider in the UK market. Coming now to our overall innovation ecosystem, we are continued to make sure that our investments in our innovation ecosystem have continued. Our patent filings have gone up on a year-on-year basis by 642 patents filed to 5,324 new patents filed. More importantly, this has gone up by 108 new filed patents in Q1. Similarly, our patents granted is now at 1,471. And I'm happy to say that in Q1, we have got 140 new patents granted. And our focus on research and innovation continues. Our conversion of that into intellectual assets that are of value to our customers also continues. Our Igneo product and our bank's products have both had significant wins, with Igneo getting more than 8 new customers and banks getting close to 10 new customers in this quarter. So this has been a quarter of significant movement on the, as I started with, but the most important aspect of it is the human element of it and the way TCSers have come together. We had spoken at the beginning of the quarter that looking at the uncertainty, we have frozen lateral hiring, but we will honor all outstanding hiring that we had issued. Milind spoke about the fact that we have been actively contacting all the 40,000 offers that we have made and engaging with them and preparing them to bring them on board during July onwards. We have also, looking forward into the demand environment, decided to selectively open up on the lateral hiring side and started onboarding new associates into the TCS ecosystem. So with that, I want to conclude the summary of this quarter as one where we have institutionalized our SBWS operating model, we have intensified our employee engagement, and we have significantly stepped up our overall interaction with our customers to ensure that we stay relevant to them and we continue to innovate with them in dealing with these unprecedented times. Thank you once again, and we'll now open the floor for questions.
Thank you, sir. We will now begin with the Q&A. In the interest of time and to give everyone a chance, request all of you to restrict yourselves to just 2 questions. Our first question is from Kritika Saxena from CNBC TV 18. Kritika, please unmute yourself and go ahead and ask your question.
Thank you, Arushi. Thank you so much, gentlemen, and hope you and your families are safe as well. Since, of course, in the interest of time and since we are talking virtually, I'm going to ask everyone my question individually, so just bear with me. Rajesh, last quarter you said that by second half of the year, you're going to see a recovery. You've retained that. So can we then assume by Q3 a recovery is going to start? And is the worst of the COVID-19 pandemic then behind us with Q1? The other point I wanted to understand is from NGS. NGS, the deal wins have been quite significant at $6.9 billion. Help us understand where they are coming from and how sustainable is this deal win figure over a period of time, especially in the next 2 odd quarters when you are going to continue to see the ripple effect of COVID-19 pandemic. And I also wanted to get a little more sense and color from Rajesh, if possible, with respect to when you can expect BFSI and capital market also to see a recovery. And of course, I understand that retail, travel, hospitality have been badly hit and have seen the maximum impact. But, by Q3, Q4, is it realistic to expect an impact given the fact that most geographies have started relaxations? Melinda, thank you very much for a very honest outlook with respect to H-1B visa and what the impact is going to be. You said it's going to be short term. Help us then understand what the impact on numbers would be as far as the short term impact is, and is it just going to be 1 or 2 quarters? And finally, a quick question to Ramki as well. Ramki, as far as margins are concerned, can you give us a breakup of the exact impact of the COVID-19 pandemic, impact of currency, and also I believe there have been some efficiencies this quarter. Utilization, of course, you don't give out, but if you can give us an understanding of how the efficiencies have given a leg up to margins. Thank you.
Sure, Kritika. Let me start off. And so from a growth visibility and a growth trajectory perspective, the broad trajectory that we had laid out last quarter, I think we are still continuing to be on that. If you look at it from a vertical industry perspective, as I said, life sciences is continuing to be positive. BFSI, we believe, should start recovering starting from this quarter onwards. However, this is based on what we currently see. And we would like to wait for 1 or 2 quarters for it to stabilize. But we should see recovery in capital markets and parts of banking starting, especially European banking, starting from this quarter, and probably North American banking coming in by Q3. UK banking sector continues to be under pressure, and it is difficult to say when that will come in. Other industries like manufacturing, the Q3 or probably Q4 would be a more realistic sense of when manufacturing and the utilities would get back to where we dropped off from last quarter. The retail travel industry is a more complex one. We could break it into 3 parts. On one end is our exposure to airlines, travel and hospitality, which the impact of it is likely to stay for quite some extended period of time, probably a year or more. Whereas the half of the remaining is what we call essential elements of retail, like groceries. And those are actually about a third of customers in our retail have had practically zero impact on a Q-on-Q basis and have been net positive. The remaining 1/3, we should see recovery towards later half of Q4 or Q1, which is essentially will go through a process of restructuring, and we will need to ride through that pain. But we believe that we should see recovery sometime in early next year. So overall, that's the color from an industry perspective. If you put it all together, when you think about the trajectory that we had laid out, we are quite confident that from rupee terms, we should be able to get back to the same year-on-year number by the time we get to Q3. So we'll be year-on-year flat in rupee terms by Q3 from where we see it today. On constant currency terms, we will come close to year-on-year flat by Q3. That's our current expectation. And by Q4, we should be able to get back to year-on-year flat on constant currency terms also. So that's the operating environment that we see. We have been asked this question in the past that you don't give guidance, and needs to be the reason we are sharing this is it's very difficult for our investors and other stakeholders to make an outside-in assessment of the company's performance, and therefore on a distinct basis we are sharing with you the operating model with which we are approaching it. Of course, this is subject to all the uncertainties that are around, but I believe that it is important for us to share that given the extent of volatility and the unprecedented company-specific situations that we are in. With that, let me turn it over to NGS and later Milind and Ramki to address the other questions.
Thank you, Rajesh. As you mentioned, the hallmark of this quarter is the institutionalizing of the secured borderless workspaces beyond the execution and delivery aspects. I'm quite pleased to see that the whole of TCS came together in embracing SBWS, and we have been able to prospect, sell, contract, onboard, and execute projects seamlessly using the SBWS model. The deal wins and the overall orders that we booked during this quarter has been quite satisfactory and phenomenal given the external situation. And it has been quite broad-based. The communication, media, and information sciences delivered one of the largest deals. And then we have won deals in manufacturing. We have won deals in financial services, insurance, and platforms have also scored its own wins. So it has been quite broad-based. Of course, retail and travel hospitality is one of the most impacted segment. And but barring that, and I think in all the other verticals, I'm pleased to see that manufacturing also turned around, in securing one or two large deals for us. So overall, it has been a satisfying quarter from a deal wins perspective, and we continue to see the pipeline growing and where we typically have at this time of the year. With this, over to you, Milind.
Thank you, NGS. Thanks, Kritika. I think short term means till end of Q4 is what we are looking at, and we are pretty, like I said, we would see some challenges because of this proclamation, but we should be able to manage that because of two reasons: because of our strong supply and delivery ecosystem in the US, and more importantly, the adoption of SWS model by our customers. Location independent model, which is going to be the new way of working anyway for us. So both of these things together will surely take care of the short term. Over to you, Ramki.
Yeah, I think on the margins, Rajesh gave the growth numbers on a revenue basis. He talked on a year-on-year basis of constant currency of 6.3% on a almost flat, or 0.4% on a positive on the reported terms. Let me also give you from a quarterly sequential basis, our constant currency decline was around 6.9%, but in reported terms, we closed with 4.1%. So when we have that level of contraction in a quarter, obviously there would be commensurate impact on the margins as well. So how have we addressed it? I think Rajesh talked about it. Let me give you a little bit more explanation around it. So as far as employee costs are concerned, our goal was to keep it at the same level rather than reducing it. So as we have stated earlier, and our model is not based on retrenchment or involuntary attrition to handle this crisis. So essentially what we have tried to do is to say that general freeze on hiring. But of course, whatever offers were there, committed offers, we honored it. And in certain customer situations, as Rajesh talked about, we had people coming in. And second is we didn't go in with the compensation increases, which we normally do in the first quarter of every year. So it is with this, it is more to manage the inflation on the current base rather than to go and reduce it. And we believe that was the right thing to do in the circumstances. But on all other areas of cost, wherever discretionary spends were involved, we actually did a lot of management on that, and some amount of rationalization on the flex poolers or subcontractors. But overall, if you look at it from the actual revenue decline, which I talked about, almost 55% we were able to claw back in terms of many of these measures without the currency impact. So that is in summary how the revenue part of it has played out. The important thing is to factor in that when you have a revenue decline of this magnitude, you will have an impact on the margins almost to a commensurate level. And that, I think, has to be built into some of the models which people have been talking about. Thank you.
Thank you, sir. And thank you, Kritika. Our next question is from Chandra R. Shrikant from ET Now. Chandra, please unmute yourself and go ahead and ask your question.
Yeah, thank you very much for that. Rajesh, I just want to start by asking you about how pricing and vendor consolidation is working out. Is there a lot of pressure from clients with respect to renegotiation, and also the deal pipeline? Because ISG's recent report said that global sourcing has come down, particularly a sharp decline in the financial services. So if you can tell us something about this, the pressure on pricing, is there going to be a lot of renegotiation as people come back? And also, how you will benefit from vendor consolidation. NGS, I just wanted to understand, in terms of the operating model now, only 1%, if I heard that right, employees are working from office. Can you tell us how this is going to work out this quarter? And Milind, final question to you. There have been reports in the last week about how a lot of IT companies have revised bench policies. They are sending employees on bench and then forcing them to resign. I just wanted to understand, have you revised your bench policies? How is utilization working out for you, since that is going to be a key lever for you to keep margins up? Thank you.
Thank you, Chandra. From a vendor consolidation perspective, there is definitely a flight to quality across our customer universe, and we are participating quite actively in that. It's more also about the fact that if you look at the nature of demand that is coming through, a lot of the demand initially in this quarter has come in terms of making sure that the digital infrastructure and the digital workplace is fully enabled and secured to allow customers to operate in this extended operating model. So that requires a very large and a full service capability, which is a limited capability that's available in the market. The large deals that we have announced, almost all of them have this common characteristic. They are all significantly about cloud migration, about rolling out digital workplaces, about rolling out new security environments, and making sure that that is actually deployed at scale and in a reliable manner. We have also had a significant interest from our customer universe in understanding the way we were able to rapidly roll into the SBWS environment. And quite frankly, it has been very openly shared with us that they found that our practices and our capabilities were far ahead of the larger competitive set, as well as with many of their own operations in distributed locations like India and other locations. So there is a lot of interest to look at operational excellence as a driver for consolidation, as also to look at completeness of service portfolio as a key driver for excellence. And I think we are at the early stages of this, and this will be a phase that will continue. And we are quite strongly participating in that. And that shows through in the deal pipeline that we have shared with you. Our total TCV this quarter is at $6.9 billion. And that's almost 20% up compared to the same period last year. And a lot of these deals have come from, so there is a spectrum of deals. The very large deals have increased, which is primarily on the digital infrastructure side. And a lot of the small deals and the numbers have also significantly increased, which is in terms of areas like reimagined customer experience and a lot of security-led activities that is happening, which has come in the smaller size. So overall, I think, as I said, there is a flight to safety, a flight to quality, and we are very well positioned to participate in that demand side. I'll hand it over to NGS to talk about the second part of the question.